Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're starting with some significant news regarding the Bank of Canada's interest rate policy. The latest job numbers have stirred up quite a bit of discussion about a potential interest rate cut in June.
Absolutely, Steve. April saw a surprising increase in the unemployment rate, reaching 6.9%, which is the highest since January 2017, if we exclude the pandemic period. It's a real shock to the system, especially since the economy only added 7,400 jobs, falling short of the expected 10,000.
The rise in unemployment and the disappointing job growth are definitely concerning. These figures suggest underlying issues in the labor market, and analysts are pointing to the ongoing trade tensions with the United States as a significant factor. Businesses are facing uncertainty, leading to job cuts and hiring freezes.
Yes, and this has broader implications for the Bank of Canada. They've paused rate cuts recently, but with the economic data deteriorating, there's increased pressure to cut rates to stimulate spending and investment. The bank has already scaled back its policy rate from 5.00% last summer to 2.75% now.
It's a tricky balance for the Bank of Canada. They have to weigh the risks of inflation against the need to support economic growth. Charles St. Arnaud, the chief economist at Alberta Central, notes that the labor market's deterioration might signal a looming recession exacerbated by U.S. tariffs.
Douglas Porter from BMO Economics also highlighted the impact of these trade tensions, especially on manufacturing jobs. The sector saw a massive hit with a loss of over 30,000 jobs, which is significant and underscores the challenges businesses are facing.
And it's not just manufacturing. Other sectors like construction, resources, and hospitality are also struggling. Stephen Brown from Capital Economics believes that without the temporary boost from election-related hiring, job numbers would have been even worse.
That's right, Steve. The public administration sector added over 37,000 jobs temporarily due to the federal election, masking the underlying weaknesses in other parts of the economy. This artificial bump in employment is likely to reverse soon, adding to the potential for further unemployment increases.
With all these factors at play, there's a strong case for the Bank of Canada to consider a rate cut in June. Analysts like Ali Jaffrey from CIBC Economics argue that the April jobs report makes a compelling argument for such a move, especially given the multi-layered uncertainties the bank is dealing with.
It's clear that the Bank of Canada has a challenging task ahead. They need to decide whether to cut rates by 25 or even 50 basis points to support the economy. The next Consumer Price Index release on May 20th could be a critical factor in their decision-making process.
We'll continue to monitor these developments closely and provide updates as we approach the bank's decision in June. It's crucial for homeowners and investors to stay informed about these changes as they could significantly impact mortgage rates and real estate markets across Ontario. Let's shift our focus to the recent Financial Stability Report from the Bank of Canada, which has raised some eyebrows with its findings on mortgage impairments. It seems there's been a significant surge in impairments in the first quarter of 2025, enough to set off some alarms internally, though not yet deemed a critical issue. The real question is, who is at risk here? Is it struggling families or over-leveraged investors?
That's a crucial question, Steve. The data shows that Canada's largest banks have experienced a sharp increase in mortgage impairments. Specifically, the impairment rate rose by 4 basis points to 0.43% in the first quarter of 2025. While this figure might seem modest, it's important to note that the volume of impaired loans shot up by 10% over the quarter and 65% since the lows of 2022. That's a rapid acceleration, and it can't be overlooked.
Exactly, Janine. The Bank of Canada has pointed out that this 0.43% is akin to the pre-pandemic normal of 2019. However, the concern arises because this acceleration is happening during a time when everything else appears stable. A prolonged trade war, for example, could rapidly deteriorate these conditions further.
Interestingly, the Bank of Canada has isolated the large lenders in its analysis, potentially overstating the overall market health. Medium-sized lenders, which often cater to riskier borrowers, have higher impairment rates. Yet, this was dismissed as a small share compared to the large banks. It's important to recognize that these medium-sized banks have been gaining a larger market share, which means their impact on the overall impairment rate could be more significant than it seems.
That's a valid point, Janine. By dismissing the role of medium-sized banks, we might be missing a crucial part of the puzzle. These lenders, while catering to high-risk clients, are often taking on borrowers that large banks have passed on, compartmentalizing the risk. This is a unique aspect of the Canadian banking system because it allows for longer mortgage amortizations than repayment terms, which can skew risk reporting.
And when we talk about mortgage delinquency, it's different from other types of loan defaults. People tend to prioritize their mortgage payments over other bills, like phone or car payments. If a homeowner is struggling, they have options like changing payment terms or refinancing. If all else fails, they can list their home for sale before defaulting. This means that a surge in mortgage impairment might not necessarily indicate household stress, but rather liquidity issues.
That's right, Janine. The inability to sell a property before it falls into arrears is rare in Canada. Home values have risen significantly over the past 5 years, so those who can't adjust their asking prices due to lack of equity are often recent buyers. This cohort includes a growing number of investors who have been replacing first-time home buyers in the market. It's no surprise that investors are behind this rise in mortgage impairment, given the red flags we've seen, such as blanket appraisals and extended mortgage amortizations.
It's a complex situation, Steve. The maximum mortgage amortization has been extended to 30 years, initially to help first-time buyers. However, this eligibility has quietly expanded to investors. In addition, the cap on mortgage insurance was increased by 50% to $1.5 million. This raises the question, how many first-time buyers need such high-leverage loans? It's more likely that these measures are benefiting investors, potentially masking the true nature of the risk.
Indeed, Janine. If over-leveraged investors are driving this increase in mortgage impairments, it wouldn't be the first time the public has been misled by data. The subprime mortgage crisis in the United States was initially blamed on low-income borrowers with bad credit, but later analysis showed that the surge was mainly due to multi-property investors with prime credit seeking more leverage. This highlights that a mortgage is typically the last payment an end user would stop making. Our final topic today takes us to the Waterloo Region, where the real estate market is experiencing a noticeable transformation this spring. A recent report from the Cornerstone Association of Realtors highlighted a 14.1% decrease in home sales this April compared to last year, marking a shift from the previously intense sellers market.
That's right, Steve. This slowdown comes as inventory levels have increased significantly, up 75% above the 10-year average. With nearly 4 months of supply now available across all property types, buyers are finding themselves with more opportunities to conduct thorough due diligence and negotiate better deals.
It's a clear sign of market rebalancing, Janine. Sellers are now facing a market that requires more strategic pricing and patience. The average sales price for all residential properties in the region was $789,639, which is a slight decrease of 1.7% compared to April 2024, but still a 2.7% increase from March 2025.
Indeed, and it's interesting to note that while sales of detached homes, townhouses, and condos have declined from March, there's been a slight increase in demand for semi-detached homes. This kind of shift in buyer preferences can often reflect broader economic conditions or changes in lifestyle priorities.
The breakdown of prices is telling as well. Detached homes are averaging $927,591, townhouses at $615,982, condos at $473,079, and semi-detached homes at $659,017. With the increased inventory, the region saw 1,936 homes for sale in April, which is a 39.5% increase from the same time last year. The average time to sell a home is now 24 days.
This extended time on the market can actually be advantageous for buyers, Steve. It allows them to take a step back, evaluate their options, and make more informed decisions without the pressure of a rapidly moving market. For sellers, it means adjusting expectations and being more flexible.
Absolutely, Janine. This shift can be seen as a healthy correction, giving the market a chance to stabilize after years of rapid growth. It's essential for both buyers and sellers to adapt to these new dynamics to make the most of their real estate transactions.
And with that, it wraps up our discussion for today. We hope these insights have been helpful as you navigate the evolving real estate landscape in Ontario.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.